is Alan Capper, and I'm here to persuade you that you want to learn about investing in fixed income, and in particular, in bonds. Now, fixed income has been a huge part of my life. I worked in investment banking and asset management for the best part of 30 years, and a large part of that time was working just in the area of fixed income. I started out as an economist when I was looking at both equities and fixed income and the broader asset allocation between them. Then I spent a large amount of time working in interest rate strategy, advising institutional investors on investment in government bonds. And after that, I was running credit strategy teams at different investment banks, talking about bonds which have been issued by companies and by banks. This has been a fascinating time, and if you want to see some television interviews when I was a guest host on CNBC, you can see these by Googling my name and CNBC, and you'll find them online. Now, there are really four things that I want to cover during this presentation to convince you that you want to invest fixed income. The first is, what is fixed income? Many people don't understand it, and the reason why they don't is because it's primarily an asset class which is used by institutional investors. There aren't so many retail investors who participate here, but I do want to clarify exactly what it is and why, for the individual retail investor, it could still be interesting. The second thing I want to cover off is actually why you want to buy it, and most importantly, then I'm going to move on to how you manage a fixed income portfolio. What does your day look like? What are the things you need to be looking out for? And then finally, we'll be looking at how this asset class differs from equity and the types of skills that you need and the types of behaviors which are going to be different if you're a fixed income manager. So let's address the first of those questions. What is it? What is fixed income as an asset class? What does it mean? So the first thing to note is that it's a very, very large asset class indeed. Why is it so big? Is because it encompasses all of the government debt issued by all the governments worldwide. And as you know, some of these governments recently have gotten themselves very heavily indebted. So it's a large and it's a growing asset class. Now, who issues debt? Who are the typical people who issue bonds? Now, here we can categorize it into separate groups. The first, as I mentioned, is sovereign governments of developed nations. So the United States Treasury, the British government, European governments, the government of Japan, they all issue bonds and they issue them in large sizes. And that represents one large sub-asset class, which is developed government bonds. You've then got another associated sub-asset class, which is non-developed market government bonds, or as we call them, emerging market government bonds. And these are governments of other countries, aside from those major ones that I mentioned, which issue debt. The approach to analysing emerging market debt is quite different because you need to really have a much deeper understanding on how the economy of an emerging market works. And the reason why is because some of these emerging market governments can actually default. And if they default, you don't get your money back. Whereas we typically make the assumption that for a developed world government such as the United States or the United Kingdom, you will eventually get your money back. These are not governments which are going to go into default. Now, the next sub-asset class is bonds issued by corporations. And those themselves fall into different groups. You have large corporations such as utilities or banks that issue very large amounts of debt to finance their day-to-day activities. You've also got a second group of much smaller companies that issue debt. We often call that high yield, smaller, lesser companies which often have lesser credit ratings. And within the high yield universe, you see that the behaviour of the bonds and the protocols through which they're issued and which they're traded is quite different to the larger corporations, which often have better credit ratings, that we call investment grade. So usually in an investment bank or an asset manager, you'll see that investment grade corporate debt is traded by a different group of people to high yield corporate debt. And then after that, you have other government entities which issue debt as well. Those might include municipalities, provincial governments, individual cities or states. These can be analysed again separately, and you need a good understanding of the economics of the local area before buying paper of this nature. So this means, therefore, that although it's a very, very large asset class, it is subdivided into lots of much smaller asset classes which actually behave quite differently and need different skills to really understand them. Now, why is it called fixed income? This is actually a bit of a misnomer. We call it fixed income, but in practice, bonds don't have to have fixed coupons. Most of them do. In fact, for the vast majority of bonds you might be trading, the two main characteristics are first, a fixed coupon, and secondly, the bond is going to mature at par in a certain number of years. Now that's of course the largest group, but there are others which actually don't meet that criteria. For example, some governments, such as the United States and again the United Kingdom, and some European governments, issue index-linked bonds, where the coupon or the maturity amount may all be linked to the rate of inflation. This means that unlike a typical fixed income bond, you have a kind of inflation hedge bundled in there. These can be incredibly popular, and again, they require a slightly different type of analysis, because if you're buying inflation-linked bonds, you'll have to have a much clearer understanding as to where inflation is going in that particular economy. And in fact, you may need to even delve into more detail as to the inflation index which is followed, because not all inflation indexes are the same, and some will diverge from each other. So you'll need to have very technical knowledge of how inflation works. Now, I mentioned that most fixed income bonds have a fixed maturity date, but this isn't always the case. A lot of bonds are callable. What that means is the issuer may have the right, under certain circumstances and at certain times, to buy them back. And this means you might be buying a bond which you think is a 10-year bond, and you might discover after 5 years that the borrower can just buy it back. That may not have been your plan, because what you thought was a 10-year bond turned out to be a 5-year bond, and you need therefore to factor that into your considerations and your analysis. There are also bonds which are convertible. This means they may start life as bonds, and then under certain circumstances, possibly at the borrower's choosing, or maybe under predefined circumstances defined in the legal documentation that surrounds the issuance of the bond, that bond becomes equity. That may or may not be a good thing. You might discover that if the bond you own becomes equity and the equity price has gone up enormously, that's going to be very, very valuable. You might, on the other hand, discover that you've bought a bond, you thought it was a nice, safe fixed income instrument, and then all of a sudden it's equity, and the equity isn't worth very much, and it won't be maturing at 100% of par. So callable bonds, again, they have a different valuation framework, and that requires understanding both fixed income and also the types of models you use to value options. But essentially, you could view them as being a bond with an embedded option, which may be exercised by the borrower. There's another huge group of assets which exist within fixed income, which are called derivatives. Now, derivatives are basically synthetic assets. They are constructed by an investment bank to behave like fixed income. So an interest rate swap is basically like a traditional bond, but the investment bank has simply put it together as an instrument whereby you get certain coupons in return for paying a certain funding rate, usually LIBOR. We can talk about those more in depth later. You can also get futures on government bonds, futures contracts on government bonds. Those are very, very actively traded because they're typically much more liquid. And rather than buying the underlying bonds, you might decide you'd rather buy a futures contract which is linked to the underlying bond. This is just as in the equity market, whereas you might decide rather than buying, for example, an index linked to the S&P 500, you'd rather buy a future linked to the index on the S&P 500. It might be cheaper, it might be more liquid, the funding might be more attractive. Again, it's your decision, but it's worthwhile considering, is that something that you can trade? And then you can also buy options on bonds and options on futures contracts on bonds. Now, clearly the lion's share of these is traded by institutional investors, but there are opportunities for individuals to trade them as well. And that does layer on the complex mathematics of how a bond trades, with an initial layer of complexity as to how the option trades as well. This therefore probably leads you to believe, and rightly so, that the bond market is a haven for mathematicians. And indeed it is. Understanding the mathematics of the different types of derivatives, the mathematics of the bonds themselves, enables you to focus upon arbitrage. So you might, for example, be buying one instrument and selling a very, very similar instrument, and by being long one and by being short another, you can extract some value in big size. Now, if you want to do that, you're going to have to find the right brokerage account, which enables you to trade both the individual bonds and the options and futures of those bonds. You'll also need quite a bit of expertise, not only in mathematics, but understanding how you can build a spreadsheet, which will help you manage the risk. And then lastly, one unusual part of the fixed income asset class is tranches. Now, what tranches are is essentially they are bundles of corporate debt, let's say 100 bonds, which are stuck together in a single basket, and investors buy different types of risk within that basket. So one investor might say, I will take the biggest risk. In other words, I will take the hit if the first 5 names default. That investor will demand a very large coupon because they're taking a lot of risk, because if 5 names default, they'll be wiped out. Another investor might say they'll take the most safe part of that bundle, and therefore their capital will only be at risk if, say, 90% of the names default. That's going to be called a super senior swap. This is a mechanism through which investment banks can package together different types of bonds and sell off risks which are not available easily in the trading market. Some of these risks will be very, very high and therefore carry very high coupons. Others will be much lower risk and will therefore carry lower or almost zero coupons. There are ETFs which enable you to participate in some of these tranches, and these ETFs are available in certain developed markets only. What this should give you a feel for is that the fixed income asset class is a very, very large and very heterogeneous asset class indeed, with lots of different opportunities that exist within it. Now, in this course, I'm only going to cover one narrow area, which is I'm going to focus primarily upon government bonds and in fact within that universe, fixed coupon government bonds. The reason why we're going to start with just that narrow area is firstly, it's probably the biggest area, and the other reason we're going to focus upon it is because in some ways it's the most straightforward to trade, it's the easiest for a retail investor to trade, but the reason why I want you to know about all these other types of fixed income is they do affect government bonds. You need to have in your back of your mind that investors are doing lots of other things besides trading government bonds, and this will impact the pricing and the dynamic of how that part of the fixed income market works. So that's fixed income. It's a huge playing field. Let's now delve into why do you want to buy it? Let me begin by saying that equity, not fixed income, was my first love. When I first entered the financial markets, I wanted to be an equity researcher. I didn't want to be involved in fixed income. I thought that it was dull and boring. However, I spent 30 years in fixed income, and I've also traded equity, and I've been very heavily involved in it, and I run my own equity portfolio. But there are very good reasons why you want to be looking at fixed income as a main part of your portfolio. Let's go through some of those. Now, the first and most obvious one is that when you're buying equity, you're buying a relatively small stream of dividend, and for the most part, you're probably hoping that equity is going to go up in price. It can go up in price by a factor of 1, 2, 3, 4, 5, 6, 20, 30 times even. So what you're looking at is putting a small amount of money down, and you're hoping to get a large payoff in a certain number of years' time. But if you're lucky, you'll get it in a certain number of months' time. That's very understandable, and frankly, that's why equity was my first love, and that's why I keep a large chunk of equity in my portfolio. The problem is that my household finances don't work that way, and they never did. For most of us, the way our household finances work is that we have a regular mortgage payment going out every month. We have a regular food bill, which goes out every month. We have automobile insurance, household insurance to pay, and these are regular bills which are relatively fixed, and it presents a steady flow of cash, which when we retire, we need to offset by a nice, steady income stream. Most equity does not provide that income stream. So as a result, it will not surprise you to learn that pension fund managers who are managing people's long-term retirement savings are very, very heavily skewing their assets towards fixed income. And this particularly applies to people whose pensions are in payment. In other words, the over 55s. So for younger people, you might think, why does this matter to me? All I want to do is to ensure that between now and when I retire, I get the maximum growth, and I can achieve that within the equity market. Why would I be buying fixed income? There's a couple of reasons to highlight why having 100% equity in your portfolio may not be a very good idea. The first and probably the most important is that equity markets can crash. I remember one of my first experiences working on Wall Street, and this was 1987. I just started, and the stock markets lost nearly a third of their value. The Japanese stock market lost substantially more. It took rather longer to actually sell off, but when it did, it was a much more spectacular sell-off. It may take years before the equity markets recover some of those losses. If you have any doubts about that, have a look at the performance of the Japanese Nikkei index since the mid-1980s, and you'll see why waiting for the equity market to rally again may be a rather painful and boring experience. Stock markets do not spend their whole time in a structural long-term bull market. There will be times when either they're selling off or they're going nowhere. And when that happens, when you're looking to exercise your expertise, the time may come to look at fixed income. Now, the second reason is you may be very good at predicting the stock markets, and you may believe that the stock markets are about to sell off. And if you think they're about to sell off, what are you going to do with your money? Now, you can sell all your stocks and you can put it in the bank. So it's all sitting in cash, and you might think that is very secure. But bear in mind, there have been banking crises in the past, and therefore you might consider that actually buying government bonds might be a securer place to look after your money if the stock market sell off than, for example, a bank deposit. Now, of course, bank deposits in many countries are insured, but the insurance is only up to a certain level. So another reason why you may want to consider fixed income as a valuable asset class is based upon your overall view on financial markets. And just as equity has its time and its place, so does fixed income. Another thing to consider as well is that in the fixed income market, and I'm talking here about corporate credit, you can get access to issuers who don't issue equity. It's not exactly the same range of issuers in the fixed income market as it is in the equity market. And if you find a particular issuer is very, very attractive, you may not be able to buy their equity, and therefore buying, for example, their high yield bonds may be a good proxy. And of course, to get access to government bonds, well, you can't get access to government equity. Governments don't issue equity. And therefore, to participate in governments, you have to do it through the debt market. You've got no alternative. So another reason why fixed income could be really, really important is you're taking a different set of bets to those you're taking in the equity market. And as any financial market theorist is going to tell you, the performance of your portfolio is based upon the number of uncorrelated bets that you take. And the more uncorrelated bets you take, the better the performance. So if you believe there are more uncorrelated views you can take in the fixed income market, it becomes a good long-term source of portfolio diversity that you don't get by investing in equity alone. So the key point here, I think, really, is that the correlation between the bond markets and the equity market is neither 1 nor is it 0. It varies over time, and therefore the successful long-term investor knows to invest some of the time in bonds and some of the time in equity, and to maintain a balance between the two. And that's science. That's the science of asset allocation. So now you know what fixed income is, and you also hopefully know why you want to buy it. But how do you manage a fixed income portfolio? So what I want to do is take you through the life of a fixed income investor. Just take you through, see what a day looks like, and that'll give you a sense of how you might be spending your time. Are we going to do it through the eyes of two different investors? The first is a government bond investor, and the second is a corporate bond investor. Now, I've been both of these, and I'll tell you to begin with, it's a very, very long day. And it's quite different to the lifestyle of the equity investor. And what I do want to share with you is that I I was in my car between 5:30 and 6 in the morning, driving into the office. And I think I do need to share with you why it's such a different type of existence. So one of the first things to note about managing an equity portfolio, I'm talking about equities here, is that you're often taking quite long-term bets. You have to take a view on an underlying company's performance, and the information about that company comes out in a quarterly reports. And the only thing which can really suddenly change is the pricing, or if, for example, the company has to release some information which is going to be negative or positive for the market. So as a general rule, the challenge for the equity investor is really getting to understand the details of the company and taking that long-term bet. The challenges in the government bond markets are really quite different. Now, the easy bit, of course, is that if you're, for example, investing in Japanese government bonds, you just have to know about the Japanese economy. You don't have to know about every company in the Japanese economy. That isn't needed. You just need to know about Japan. So that means the amount of information you need to know and the degrees of financial modelling you have are much smaller. So it won't surprise you that the economics departments and the interest rate strategy departments of investment banks and asset managers are often a lot smaller than their equity research departments. The big challenge, however, is that there's information coming out every day, often several times a day. So you need to focus upon every single important economic release that comes out of United States, Japan, wherever you're investing on a daily basis. And you have to assess those reports pretty much immediately, because the markets will move very, very fast. So the type of reports you're looking for, what are they? So these are the things that matter, that drive the government bond market. So number one is going to be interest rates, governments changing monetary policy. Number two is going to be any changes to fiscal policy. But clearly, huge amounts of new debt issuance is not going to find favour with the financial markets. Number three is anything that affects the currency. Again, if you're a US investor, you've decided to buy Japanese government bonds, chances are you've got exposure to the yen. Now that'll affect your portfolio in two ways. Firstly, it means you're long yen against dollar, and therefore your currency volatility will affect your total returns. And the other thing is that clearly the Bank of Japan and the Japanese Ministry of Finance will be watching the yen, and their attempts to move the value of the yen, if appropriate, could have an impact on the bond market. You also want to watch pricing. This is where it can get quite complex, that in the equity market, each issuer usually just has one tranche of equity issues. Sometimes there are multiple tranches, but you can often typically only invest in one of those tranches of equity. The Japanese government, for example, may have hundreds of bonds in issuance, hundreds of treasury bills, and therefore the amount of data you need to follow on a spreadsheet is substantially larger. So as a result, price movements in equity are much easier to measure as there's simply less of it to track. Whereas price movements in the government bond markets, and certainly the corporate markets as well, require a lot more skill and a lot more data processing capability to track. So one of the things that you're going to be, if you're going to be looking at government bonds, is you're going to be very, very equipped to manage a spreadsheet, keep this data on spreadsheets, look how the market's changing, and in particular, follow very, very carefully every single release that comes out. Now, this means not only following it in the newspapers, you also want to see what the analysts think about the individual releases as and when they come out, and therefore tracking podcasts from different analysts, tracking financial markets research if you can get hold of it, is absolutely critical. Now, since it takes time sometimes for people's analysis to come out, you'll need to be able to actually look into these data releases and understand what they mean for your portfolio. So my take very much on the government bond investor is that he has something new coming out every day virtually, something new to analyse, and a huge number of spreadsheets to track because there's a lot of data for you to cover. Now, I mentioned earlier that if you're looking at developed sovereigns, the United States government, for example, you're not expecting it to default. If you're looking at developing sovereigns, however, the risk of default is very, very real. And that's a term which is absolutely critical to your portfolio, understanding what might drive a default, because bear in mind, if a government bond price drops from, say, 100 par to 90, in however many years it may come back, it may be a temporary thing. But if you own something that defaults, it's gone, and it's usually gone for good. So watching for risk of default is very, very important. So understanding the financials of these developing markets is absolutely critical. Any new information will be very, very relevant. And of course, bear in mind, as I said, these are all markets which move very, very quickly. So what you might discover is when you've done your analysis at your leisure and discovered that for whatever reason a certain borrower might default and you decide you want to sell that bond, it's too late. There'll be no buyers. You'll be stuck with it. So just as with the equity markets, liquidity can dry up, the same can be said of fixed income markets. Don't assume you can make the trades you want when you want. So that's the day in the life of the fixed income investor in the government bond markets. He's looking at economic data, he's looking at pricing, and he's spending a lot of time collecting data on this and seeing how new trends evolve. Now, in the corporate credit market, you are not getting information coming out at the same pace as you're getting it in the government bond market. And again, you might take the opinion that you're taking rather longer term views, and therefore your schedule, rather like an equity investor's, is driven much more by quarterly company results, understanding the industry in which the corporate borrower exists, and understanding when new issuance comes out. But of course, you need to bear in mind a large part of that corporate bond market is bank issuance. And banks are very, very levered to the underlying sovereign's performance, which means if you're looking, for example, at French banks, their performance is highly levered to the French sovereign. And the same is true for banks in other jurisdictions. So if you're buying corporate financial debt, you need to really understand how the macroeconomy is working, and in particular, the parts of the macroeconomy that relate to the banking sector. So you can end up with a lifestyle which is actually quite similar to a government bond investor, because that close relationship between banks and their underlying sovereign. When you look at the non-financial world, it's rather different, because the non-financial world, you need to understand the individual sector, and in some, let's take telecoms as an example, telecoms don't really behave in the same way as their underlying sovereign. And therefore you'll be spending your time, rather like an equity investor, thoroughly understanding the dynamics of the sector and the individual companies which have been issuing in that sector. Now, of course, you're going to buy more than one bond, and therefore it's important to understand the correlations between different sectors and the correlations between different bonds. So when you put your package of securities together, you've got the optimal number of uncorrelated bets. Now, the corporate credit market has one nasty little tweak, which I think people do need to be very aware of. It's much less liquid than the government bond markets. And therefore, if you take the view that you want to sell something because you think the news has degraded or the pricing has moved so far your way, it's no longer attractive, you may discover you can't. Just as some of the developing government bond markets can go very illiquid very quickly, the same is true for corporate bonds. So being ahead of the game is really, really important. So much of what you should be doing as the investor in corporate bonds on a day-by-day basis is really making sure you understand what future trends in your sector might look like, or whether the pricing has fully reflected that. You may have a great momentum trade, it's going your way, but knowing when and how to get out is absolutely critical. So one of the things I always tell people is that you not only need to know how to get in a trade, you need to have an exit strategy as well. One last thing, which I think defines the day very much, both an interest rate strategist or a government bond investor and a corporate credit investor, and this really contrasts very, very much with someone who's involved in equity, is your mindset. If you're an equity investor, as we discussed earlier, you're looking for these huge returns, which means partly you want to be an optimist, of course. And it means you need to look at both your downside risk, because you don't want to get wiped out. A company which goes bust, you won't get any of that money back. But of course, what you want to ensure is that you're mindful of those 2 times, 3 times, 4 times, 5 times returns that you may get by investing in equities. So you want to be an optimist. If you're investing in fixed income, your best case outcome is that you get the coupon. The coupon you'll get until maturity date, and then you'll get your money back at maturity. There's no better outcome than that. There's no upside of 3, 4, 5, 6 times unless you just happen to be buying some very, very distressed debt. In general, that is your best upside, the best that can happen to you. What you want to ensure is that things don't go wrong, which means you're going to be a pessimist. You want to make sure nothing happens that undermines the value of your investment, because the upside is not high and the downside is 100% of your initial cost. So this means the mindset of a fixed income investor like myself tends to be, you go looking for trouble. You go looking for things that might go wrong. Whereas the mindset of the equity investor is you're looking for things that might go right. And that's a fundamental difference in the mindset and how you spend your day. So to sum up, I think if you're considering investing in corporate credit or government credits, you need to very much consider where your skills and expertise lie. If you think you understand corporates well, you're interested in a particular sector, you have good knowledge of that sector, that gives you a great advantage, and by all means buy corporate credit in that sector. If you're an economist or a mathematician and you know the economy well, or you're willing to delve into the mechanics of 2 similar bonds which are trading quite differently, then get involved in government bonds. And of course you may want to get involved in both, but do bear that in mind. There are quite different skill sets involved, and as a result, to incorporate both in your portfolio does give you more uncorrelated bets, so it's always worthwhile considering. I said at the beginning of this presentation that equity was my first love. Even as I'm speaking to you now, I have on my screen here the equity markets flashing up. I can see what's moving, and I can see how my portfolio is performing. It's the first market that I wanted to follow, and this is where my heart is. The problem, as I hope I've articulated to you, is that equity markets do not spend the entirety of the time rallying. They have some very, very sharp bear markets. And then there are times when the equity market simply does not go anywhere. And in order to finance my life here, I need to turn to bonds. I also recognise that my background is as a mathematical economist. That's what I was trained to do, and therefore that my capacity to understand fixed income is probably somewhat greater than equity. So whilst it may seem as a rather boring asset class, a very challenging asset class, and I'm speaking as someone who was, as I said, driving into the office in the early hours of every morning to catch a news flow in Japan before following the European markets, and then staying up late at night watching what was happening in US Treasuries and then the Japan opening. Fixed income is hard work. But hey, it has a number of compensations. The first is that, in general, it's a lot less volatile than equities. So when things go wrong, they typically don't go as badly wrong as they might with the equity market. Second is that it presents another series of ways of making money. If the equity market is not going anywhere, you've got no choice but to start to look at fixed income as an alternative. And a third, and this is the really exciting bit, by the way, it's a much faster moving market. There's so much more going on, so much more news flow coming out every day. Certainly in my view, it gives you a rather more stable lifestyle. So when considering whether you want to participate in our fixed income tournament, which at this stage we're primarily going to limit to government bonds, and only a certain number of types of trade you can put on in the government bond markets, I would strongly advise you to consider what skills you've got, how you like to spend your day, and in particular, whether you think that managing a fixed income portfolio is going to be something that matters to you over the coming years. Personally, I found it to be an exciting ride, a wild ride, and it's going to be a great experience to see which of you can manage to outperform. So when you're thinking about putting your trades on in fixed income, the question that I'm going to put to you on every single occasion is, why did you put on that trade? It's not only about the money, it's about the process. What was the logic behind it? And I'll be looking very carefully at that logic, because ultimately, the investors who make the most money over a long period of time in fixed income are those who have a good, solid process that they can justify what they've done and why they've done it. So anyhow, I'll be around for surgeries and to answer your questions. I really look forward to hearing from you, and I'll be putting a reading list and a video list up there that you can have a look at later. Thanks for watching.